Hello, my name is Mike Smith and I'm the president and founder of T&K Futures and Options Incorporated. Today's educational video is going to be about the live cattle market. But before we get started, let's go ahead and cover the risk. Futures and options investing carries significant risk of loss. It is not suitable for some investors. Past performance is not indicative of future results, and you should only use risk capital for these types of investments. Okay, over the 20 plus years that I've been a commodity trader, I've heard a lot of the same questions over and over again, and really I just want to cover those with you today and as they pertain to the cattle market. So the first question I typically get is, how does margin work? Margin in futures contracts. And what margin is it's a good faith deposit that the exchanges dictate how much that's going to be. Okay, and that's money you have to have in your account, a minimum money that you have to have in your account before you can go long or short any commodities. And they're the ones that pick that, and they raise it and lower it based on what's going on in the market. So, for instance, if it's an extremely volatile time for the cattle market, the margins, they might raise the margins to try to slow down the amount of speculation that's in there. And if it's a really slow time, they might actually lower the margins to try to incentivize more people to come in and trade, because they make their money when people are trading their accounts. So it goes up and down, it changes all the time. But for now, I checked this out today when I did this video. It's actually $1,320. Okay, so let's say you open an account for $50,000 and you wanted to get long 1 April live cattle contract, and it costs $1,320. So if you did that, here's how much money you'd have left over. You'd have $48,680 of available equity to do something else with. Leave it in the account just in case the market moves against you. You could get other contracts, you could buy options, whatever you want, but you got to have at least this much in there. This much is available to you. The contract for live cattle it's a 40,000 pound contract, and every 1 cent move is equal to $400. Okay, so let's say you get long 1 April live cattle at $1. It's not at $1. These are hypothetical. These are all made up. Just doing it for easy math. And let's say that the market went from $1 to $104. Well, that's a 4 cent move. Every penny is $400, so that's a $1,600 move that you had there to the good. Actually, I don't even think it can move 4 cents in a day. At the time of this, it's at a 3 cent limit. But anyways, hypothetically, all right, just showing you the math here. So goes up 4 cents. Well, that's a $1,600 move. Okay, it's a good day for you if you were long. You made that in your futures contract. Well, conversely, if it went down 4 cents, well, you lost yourself $1,600. So bad day for you. And that leads me to my next question that I typically get is, how do you manage the risk? You might be able to read this, see this. It says infinity risk. Okay, theoretically, there's no. It's infinity. It's infinity. An infinite amount of risk to the upside. Let's put it that way. If you're short this market, obviously no one's ever lost infinity, but theoretically there's no end to how high numbers can go. So therefore, you have theoretically unlimited risk to the upside if you're short a contract. Okay. Now, if you're long a contract in the cattle, it can only go down to 0. I doubt that cattle will ever have 0 intrinsic value, but theoretically, again, that's the limit to the downside. So infinity to the upside, 0 to the downside. Very risky. That's what you should take out of this, is the futures market are very risky. So the next question I typically get is, how do you manage that risk? Okay, my opinion would be to use sell stop in this particular case. So it's a sell order that you put below the market. And let's say you're wrong. You got a dollar, you're betting higher, market keeps going against you. It goes down 98 cents, 96 cents. As soon as it sells through that 96 cent level, it turns into a market order. And the way a market order works is you're going to get the next available price. So that's why when I say risk, and I got 1600-ish, you don't really know what that next available price is going to be. Might be 96.05. Might be 95.90. Might be right at your 96 cents. You just don't know. So that's why I have the ish there. But even though it's not exact, that's the way I would trade futures, if I were you. That's what I would suggest. Okay. The next question I typically get is, what is a call option? A call option gives the purchaser the right but not the obligation to buy the underlying futures contract, live cattle, for a specific time period, April, at a specific price, $1 Okay, so let's say you wanted to do that. You wanted to get this call option right up here, and let's say it cost you 3 cents. Okay, well, that's not right. 3 cents would be $1,200. So that means that particular option would cost you $1,200 in premium. This one right here. Okay, so now let's say that you bought this 104 and the market was at $1. Goes up 4 cents, it's a $1,600 move. You're only going to catch a portion of that move. You're only going to catch whatever your delta factor says you're going to catch. And hypothetical, again, made this up. Let's say that your delta factor was 25%. Okay, well 25% of $1,600 is $400. Okay, so in this hypothetical situation, futures went up $1,600. Your option's going to catch $400 of that. You paid $1,200 for it, so that means your option today went up in value by about $400. Ish. Again, there's another ish there because that's changing constantly. As the market's moving up and down, that's changing. There's other factors involved. There's the theta, which is your time decay, that has to be factored in. There's vega, which is your implied volatility, your volatility premium. That also affects the price of these options as they're moving. So this is constantly changing. So again, that's why there's an ish there. Because it's not exact again. But it's a good day nonetheless. All right, let's say conversely, you bought this option while the market was at $1 and it came down 4 cents. Well, now you're going to lose roughly $400. So when it went your way, you gained, hypothetically, $400, so it was worth $1,600. Well, this time you lost $400. The market moved against you and you lost by 25%. That's confusing, I know, but that's how delta factor and options work. The next question I typically get is, what is a put option? Well, a put's just like a call, except the opposite. It gives you the right, but not the obligation to sell the underlying futures contract for a specific time period at a specific price. And the way cattle works is a little different from most options. These actually expire in the same month. Most options expire the month before. So if you had an April position, say it expired the first week of April. That's usually not the case. Most options expire the month before. But I didn't look it up, but I should have. But that's what the expiration would be on this one. Okay, limited risk. Also here, what's the worst case scenario when you buy an option? Well, let's say you bought this hypothetical option again. Your worst case scenario is you can lose whatever the premium you paid, in this case $1,200, plus whatever commission and fees were. So that's your maximum risk when you purchase an option. So your risk is finite. You're not going to get any margin calls like you can with the future side of the equation. But I think that's it. I think I covered everything. Okay, here's the website, tkfutures.com. If you have any questions, you can go there and find the contact information. Call me and ask me a question. Also wrote a book called The No Nonsense Guide to Buying and Selling Options. As the title suggests, it's all about options. It doesn't cover futures at all. You can get that on Amazon.com. Another educational resource. You can also try one of our practice accounts. They give you a virtual $50,000 to trade with, real-time charts and quotes, so you can practice before you put any real money towards it. But that's it. So Hope you learned something, and have a nice day. Bye-bye.